Hi, Tim Kerin here from Mortgage Choice in Kingsley. Today I'm going to talk about what happens when it's time to move out of the home you're currently in. Often I talk to people who are ready to buy something that's perhaps a more expensive property than the one they live in, or maybe downsizing to a cheaper property than the one they're living in. And the question comes up about how many times you need to move house to do that, whether it's possible to own both properties at once, whether you have to sell one first in order to buy the other one, whether you can do a bridging loan, and so forth. There's a few different ways to deal with this, and long story short, we should talk it through and figure out what the best option is for you, but I'll go through them now. Probably the most straightforward way to do things in terms of lending is what's called loan portability, which is essentially where you pick up your existing home loan and move it to the new property. In order for that to happen, you need to be selling the first property and buying the second one simultaneously. And that can be challenging to coordinate, but if you can coordinate like that, it's really easy from a home loan perspective because you don't need to qualify for a new loan. You pretty much just pick up the loan and move it to the new property. It's often called a security substitution too. Most lenders, as long as the property is fairly similar to the existing one, allow you to do that. And then you don't need to do a full loan application. It's pretty much just an administrative thing with the bank. The next way to do things, if you're capable of doing it, is proving to the lender that you can actually afford to own both properties at the same time. You need to prove you've got the borrowing capacity to do that, and also the equity. And so we might do a loan application for you to buy the new property without that being subject to the sale of the existing one. And in that loan application, we would therefore treat the existing one as a potential investment property and include the rental income that you would expect to get from it for as long as you continue to own both properties. So if you've got the equity and the borrowing capacity to do that, to me that is the straightforward option that allows you to own both properties at once and gives you the flexibility to sell your existing house whenever you like, rather than having to do it in order to buy the new one. If you can't do that, if you can't prove the borrowing capacity to make that work and own both properties at once, well, that's what a bridging loan is for. A bridging loan, pretty much by definition, is to bridge you across that period where you need to own both properties, even though you can't prove you can afford both the debts. What goes along with that is that you must sell the existing house within a certain period of time, usually 6 months, sometimes 12 months, depends on the lender. And therefore they can assess your borrowing capacity based on the end situation once you have sold your existing property, rather than needing to prove you can afford all the lending required to own both properties at once. To me, that's something I would, generally speaking, resort to only if we can't prove that you can afford both properties at once, because it takes a little bit of control out of your hands and puts it in the hands of the bank. Those are basically the three main ways. How you structure the loan application is probably another dimension as well. If you are going to own multiple properties, do you just borrow all the money you need to buy the new one? And do you keep that separate from your existing property, or do you cross-collateralize? And these are the sorts of questions and details that come up when we go through things on an individual level. So if you'd like to discuss that and discuss how I can help, please get hold of me and we'll look at your personal situation and see what's the best option for you. Thanks.